And welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. Bitcoin ETFs launched last week with big volume. So how are they trading? What's next? Let's ask Catherine Clay. She's the Executive Vice President and Global Head of Derivatives at CBOE Global Markets. Also joining us, Dave Nadig, Financial Futurist at VettaFi, and Jennifer Grancio, Head of Global Wealth for TCW. She'll join us later in the show. Catherine, we had, 10 spot Bitcoin products launched last week. CBOE launched 6 of those 10. How are these products trading relative to Bitcoin? I just want to make sure they're tracking, because that's what the viewers want to know about.
Well, Bob, as expected, these ETFs are exactly tracking Bitcoin, and that is the intention, and that is what we're observing.
I love to hear the traders screaming in the background. It does, as an old floor guy myself, it does my heart good to know that people are still screaming at each other on the floor. It sort of seems like the next...
Yes, it still happens here on the CBOE floor.
It seems like the next logical step is options on spot Bitcoin ETFs. What can you tell us about the process? How far along is CBOE with that?
Well, we agree with you clearly that options are absolutely intended for these ETFs. We believe that the utility of the options, what they provide to the end investor in terms of downside hedging, really risk-defined exposures into Bitcoin, really would help the end investor and the ecosystem. And so we have filed with the SEC to be able to list options on these spot Bitcoin ETFs and are awaiting the regulators.
So I want to bring in Dave here. Your observations matches Catherine's. These are tracking Bitcoins accurately. Is that right?
I don't think there was much question the funds would do what they said they're going to do on the tin. All they hold is Bitcoin, so they're, of course, tracking very well. The spreads have been tight. The volumes have been fantastic, something like 10 billion traded so far. That puts them in the top 20, 30 trading ETF buckets out there. So absolutely the liquidity there. When the options come on the online, however, I think that opens up a whole new market here, because once that options ecosystem is completely baked, I think you're going to start seeing all sorts of hedge fund players in the space, folks who might not have been traditionally speculating on crypto directly in the crypto ecosystem are now going to have something to play with.
Yeah, and how is it going to change? Will that affect Bitcoin at all? I mean, what is options going to do?
Well, so if what happens in Bitcoin is what's happened in single stocks, we're going to see retail in particular and a lot of institutions move towards zero data expiration options trading on Bitcoin itself. It's got inherent leverage in it. Yeah.
Now you're really bringing up a can of worms. Bitcoin with zero data?
Yeah, I think it's absolutely what we're going to see. I think it's going to involve a lot more money chasing the top 3 or 4 Bitcoin ETFs that have the most volume. I suspect that the iShares product, iBit, will be the one that gets the most vibrant options market just because of the liquidity we've already seen. You know,
I can't help, and Catherine, jump in, but I can't help but notice that Bitcoin's 2-year peak in price occurred the day the ETFs went public. I mean, we were at like 49,000 intraday.
And now we're 42,
and now we're 42, something like that. So we call this the inclusion effect. Those of us who study indexes, you know, this happens when companies going into the S&P 500. It happened with the gold ETF in 2004, run up, and then it just sort of flattens out a bit.
Yeah, it's sell the news, right? I mean, it's speculative assets. When they trade on narrative like this, you always sell the news. I think it's a mistake to think that this is going to go straight down. However, it's definitely a new set of buyers, and more demand means higher prices.
You know, Dave
and Bob and Dave, I would like to jump in here.
Go ahead.
I think we're getting way ahead of ourselves when we start introducing the concept of zero DTEs, these short-dated options, on these Bitcoin ETFs. We still have not even received approval to list options, so let's not get ahead of ourselves and think about zero DTEs. We want to get options on these ETFs in a very intelligent and thoughtful way that actually, as Dave is talking about, really builds the ecosystem of new entrants into the market, being able to lay off risk and to really define what type of exposure the end investor or those RIAs that are working with their clients to actually define what's appropriate for a portfolio that an end investor has. So zero DTEs, later conversation. We're still in a holding pattern with the regulators to get these options approved.
No, it's not. We're having the conversation now. See, Nadig isn't waiting for anybody. I know you have to do that. We got where you're at, Catherine, but he doesn't have to do anything.
Catherine's point is correct, right? There are a lot of steps between now and there. But to me, it's pretty obvious that's the ultimate direction. Yeah. In between, however, we're going to see all sorts of covered call writing strategies, buffered products. Everybody's going to start using options around Bitcoin.
All right, he brought it up, okay? So don't get mad at me, Catherine. Zero data expiration options were a huge hit. You were very involved in all of that last year. I think half of options trading is now zero data expiration ones. I know CBOE's already moved on the Russell 2000. Tell us a little bit about all of this. I mean, we're kind of astonished watching this, how big it's become. Tell us about what percentage of retail traders. We can't seem to figure this all out. Do you have any data on this? It's fascinating to us.
Yeah, for sure. And let's just back up a little bit and understand that it's not zero DTEs available in every optionable underline. These zero DTEs are only available in index option and select ETF options. So they are not even in the single stock universe. And for reasonable reasons, that hasn't made that migration yet. But there has been tremendous growth in our index options. And for sure, it's been led over the past year by these short dated options, these Tuesday, Thursdays expiries, because it actually lets investors fine-tune their exposures to events and to different sentiments that they may want to express on a day-to-day basis. And at the end of the day, since these index options are cash settled, they can then redeploy their capital in new ways. So we do see a lot of growth coming from those zero DTEs, but just want to make it clear, they're not extended to the entire optionable universe yet. And so when I say we're ahead of ourselves in this conversation, that's why.
Well, that's what we're supposed to do. We spin stuff ahead. It's the media. So do we have any data on how many retail players are in this? Because people will come back and say, well, no, the market makers are the primary people using these. But I find that hard to believe. I don't have a lot of really good, solid data on who is using these. It seems like it's got to be some mix of market makers who are hedging themselves and other people and retail investors.
Yeah, I mean, obviously, it's anybody who's looking for that kind of exposure, which includes some retail and plenty of institutions. If you tease out contract sizes and the average trade size, you can make some guesses about what's retail and what's not. Last time I ran those numbers, it was less than half. I think the media tends to get really, yeah, I think people get excited and think that this is every mom and pop investor. On any given day, I've been able to account for 20 to 40%, depending on it. The rest of it's institutions, it's market makers, it's hedge funds.
But you know where you're going with this. Do you have any concerns about this, sort of sucking in retail investors who are thinking now we can let's play this every single day because it expires every day? Gensler has already expressed concerns about
So I'm all for sharp tools in the drawer, and zero data expiration options are sharp tools in the drawer for people who have those needs. Obviously, we're making that available to anybody who can get approval to trade options. But remember, you don't need approval to trade an ETF, and you can get triple leveraged, all sorts of stuff.
Yeah. So I guess the question here is, is there any issue with the market becoming kind of one-sided? I mean, look what happened to JEPI. JEPI is essentially you're buying S&P 500 and then you're buying covered calls on it. So the options market CBOE is doing fantastic. The stock's doing fantastic on this. Congratulations.
I have
Catherine.
to say, so Dave is backing into the analysis of how much retail trading is happening in our products, and that's great. But we actually have the data at CBOE, so we can get a really focused look on who's using the products, what kind of strategies are deploying, what is the net aggregate risk across the landscape from all of these participants. And we know that about 47% of the trading in these zero DTE options and SPX are from retail traders. Yeah. And we know the types of strategies they're employing.
Okay.
And most of these strategies, by the way, are very risk defined. They're spreads, they're outright call and put options buying. We see very little naked short selling of calls and puts. So we feel good about the health of the ecosystem.
So that sort of drives with what you were saying.
Yeah, absolutely, right? I mean, if you look at the education that the industry's done, most of the discussion about zero data expiration trading isn't about just taking a flyer on giant leverage. It's about doing iron condor spreads and calendar spreads and learning how to use these tools effectively. Is it appropriate for every retail investor? Of course not. Is it appropriate for plenty of retail investors? For sure.
All right, I'm going to leave it here. I want to move on. Catherine, thank you very much for joining us. Congrats on the Bitcoin ETFs.
Thank you, Bob,
Congrats
Dave.
on the zero-day expiration. You've had success. You can't argue with success. Thank you, Catherine. Appreciate it.
Appreciate
I want to
Bob.
switch.
Thank you. All right.
Sure. I want to switch gears and talk a little bit about climate change, energy transformation, infrastructure. Jennifer Grancio is here. She is the head of global wealth for TCW. TCW recently bought Engine No.1. You might remember them. The company, they became famous for winning 3 seats on the board of Exxon with a demand to take climate change more seriously. And I wanted to bring Jennifer back for an update. And last we spoke, what was it, 6 months ago? I wasn't at the conference in California. TCW had just bought Engine No.1. The 3 ETFs, you went along with them that you managed. What's the difference? Is there any difference in Engine No.1 and TCW? Has the management different or the same?
Yeah, I mean, TCW it's a great firm that's known today for fixed income, but they've got a heritage in active equity. And so, more resources against the same 3 great strategies.
Now, there's 3 ETFs here. We're going to put them up because I want to make sure that, and you brought them over. The Transform Systems ETF, NETZ, the Transform 500, that's the vote, and the Transform Supply Chain, that's SUPP. But there seems to have been some subtle changes. So the old climate change ETF is now called the Transform Systems ETF, NETZ. Here, I'm putting up some of the largest holdings here for them, including Republic Services, as you can see, in Union Pacific. The old one seemed to be more focused on climate, and this one seems more focused on the energy transition to net zero carbon emissions. The website describes this as brown to green companies, for example. So is there a subtle difference between this one and the old nets? And tell us what's going on here in this one.
Yeah, I mean, I think if you think about the huge transformation that we're seeing in energy and power and how we consume energy and power, as well as how we're more efficient in using them, it's going to take a long, long time. And so we initially described it as climate change. We think a better way to describe it is it's the system, right? It's the system on how this changes through time. And we manage it actively. And so as we go through different market cycles, obviously we have different opportunities. So if you look at, for example, energy last year, tough year for energy. A lot of people think about investing in transformation and investing only in green. Lithium was down, wind was down, solar was down last year. And so if you think about investing through time in the transformation, you really do have to hold these old economy companies and hold the people that are going to win and lead through the transformation.
One of the things that I love about the way you guys run money is that while you're known as sort of being activist because of the Exxon deal, you're also active in the sense that you actually just talk to management. You try to get companies to work together. How is that mapping from what you guys did with Exxon and Vote to now, for instance, what you're doing in net zero?
Yeah, so in the Net Z ETF, we hold the energy names still. A good example is we often find ways to kind of unlock something from an economic perspective. And so if you think about it in energy, Occidental, Exxon, they're building actually economically viable businesses around transformation. Another one is Republic Services, which we hold in the portfolio. It's a garbage company.
Yeah, I was about to say, aren't they the garbage company? Yeah.
But the garbage company is very well positioned to appreciate and value. And they both have a great fundamental business. It benefits from all the reshoring and manufacturing, which we also
how are the garbage
excel.
companies? I know Waste Management always shows up in these kinds of things. How is that going towards net zero? What are they doing to make it on your list?
2 things. So one is they're building green natural gas out of the landfill. So it's a secondary business. It's a very high ROI business for them. So they're making money on that business. The second is from a circular economy perspective. We actually brokered a deal between Republic Services and Coke. Coke wanted recycled material. Coke had to kind of get to an economic point where Coke could pay the price for recycled material and Republic Service could manufacture it. And that's led to a huge kind of build of recycling centers across the U.S. that Republic is doing. So in a lot of cases, we don't have to be the bad activist because people are getting the joke a little bit. And as an active manager, we're going to hold names in the portfolio where we're just going to make money as we go through these transformations.
I could see industrial names like GE and garbage companies like Republic Services, but Microsoft is 7%. How did that make it in there?
Yeah, so Microsoft is an enabler of this transition. And so again, we think about what we do at TCW and the ETFs is they're very broad. These are durable megatrends. They're not thematic. You hold them for a very long period of time. And so we hold energy, We hold aerospace. Aerospace is a big efficiency play. And we also hold companies like Microsoft that are doing a better job with water and energy efficiency. You think about data centers, those are monsters.
Right.
And so if Microsoft has a better technology to be more efficient with energy, they're going to get rewarded.
And here's where AI could possibly come in helping them analyze things. You get your free AI plug here. Every company's an AI company now, might as well. So, but I'm being facetious, but you could see how they could apply AI to better analyzing.
Yeah, that's right.
But this is also, I think, one of the real use cases for active management, because to your point, Microsoft just shows up as a tech company or a software company on any given screen, any given index. But when you actually peel away the layers of the onion, you look at some of these enormous mega corporations, some of them are really advancing green causes. Microsoft in particular has probably done more for water infrastructure than any company in the world, and they're not a water company, right? So those things, I think, really get unlocked by an active manager who's willing to get under the hood and also to have conversations like you're talking about the example with Coke. I think that's very inspiring and very hopeful to me.
I want to move on and talk about a couple of the other ones that you have. The Transform 500 ETF. This is the vote one.
Yep.
You became sort of famous off of this, applying, I guess you would call it proxy voting guidelines and engaging in dialogue with management. Is there any, I see Microsoft, Apple, Amazon, and this tracks the S&P 500 essentially. But are there any proxy votes you're actually engaged in? There haven't been any big campaigns publicly since Exxon, right? I mean,
that's right,
how does this work now?
So like think about it from a TCW perspective as we think the holding the passive is not enough. We think there are these mega trends. You can't just play them in alt, you should play them in public, so net, Z, and sub. But then if you go back to the core, a lot of people hold large cap. When you hold large cap, you have to use the votes. Like that's the game. Is we hold the companies. They have an annual meeting. You can ask the company to do a better job paying their executives so that they increase in value over time. You can ask the company if they're in an emission business, what's your plan on emissions? So
are you doing any of that? I guess I'm trying to figure out. The viewers want to know how are you engaging with this?
Yeah. So if you think about vote as a product, we vote the votes every year, and there were about 720 of these votes last year. We vote them in a way that drives long-term outperformance for companies. And so it's a passive vehicle, but you're being active with the voting. Now contrast that to the other big three, two of whom last year voted in favor of only, I think it was 2% and 7% of these proposals around governance and running a business to make money.
And
we voted in favor of 85.
Those whose names shall not be mentioned. We're talking about BlackRock and Vanguard.
We may be. And if you look at that 2 and 7 compared to vote voted
Is that
voted
a real
in favor
number? 2%? Do you think that's true?
Voting against management.
2%
voted
and
against
7%.
Management. Right. And how much did you vote against management?
84%.
You voted against management.
And so that's the way that we should be using the proxy votes in these passive vehicles to make sure, not for any agenda, just to make sure that we're paying CEOs correctly and companies are giving us data so that we actually are kind of disciplining these companies to make money for our shareholders over time.
How do you feel about what happened to the whole ESG debate? I know you've sort of moved on. You don't even like to use the word here, but it's quite amazing. A lot of us, he and I had intellectual issues with ESG for years and years about how you can smash these three together, metrization, how you actually, qualitative analysis involved in it. We had debates for years about this, and we had problems with ESG, but nobody had a debate about the fundamental problem, like who's voting for more pollution? I vote for more pollution. Who votes for less diversity in the boardroom? I want less diversity in the boardroom. None of us is against any of that. We had sort of intellectual disagreements around the structure of the whole thing, but somehow the thing morphed into this crazy debate. I mean, how do you feel about all that?
That's part of our point of view on this is that you want to use governance always matters. Environmental data matters as fundamental data when you're picking stocks. Social is workforce, right? Workforce, how you treat your workforce versus your competitor. That all matters. The industry made a mistake and they created ESG products. Right? You're supposed to use that as underlying data for an investment process.
So you think it was a mistake for the industry, for the ETF industry, to sort of jump on this ETF?
And I think we're in a better place now where the best active managers are actively using all of that data to figure out who wins and who loses through time to make money.
Do you agree with that? It's an interesting point.
I disagree a little bit. I don't think it was a mistake to launch ESG products. I think there are classes of investors for whom a plain vanilla ESG fund tracking the S&P 500 with a twist is in fact what they need, whether it's because they have a mandate from their board or whether it's because they just choose to invest that way. I think where things may have gotten out of hand was the amount of hype we had around it. I mean, we all know that the media needs a story to feed on, and for a good long time that story was ESG. I think it's worth pointing out that ESG didn't go away. The flows may have died down a little bit last year, but almost all of the basic S&P 500 ESG spinning funds beat the S&P last year, right? There are reasons why these strategies bring long-term value, and the fact that they got painted with this big, broad brush, I think is a disservice to the way of investing.
It probably was a mistake, but in retrospect, remember, the ETF business is a business. So it's a popularity contest, right? We saw this with thematic tech ETFs.
Yeah.
All of a sudden, they buy at the top, thematic tech, cybersecurity. And then we saw it with pot ETFs, even though there was no pot to buy, literally. We saw this with Bitcoin in the early days. There was no product out there, and yet it happened because the ETF business is a popularity contest. It chases whatever. And there was a time, ESG was the hottest product on the planet. In 2018, 2017.
Although, to be fair, the flows never matched the hype, right? They were the hottest product in terms of what we all talked about, in terms of people calling me. I mean, I got tons of advisor phone calls. We had whole advisor practices built around it. Yeah. But at the end of the day, it was never the kind of flows tsunami that we've seen.
So this is not going away, politics aside. And your point is we now have like an obvious discussion to go around. Carbon neutral, where companies, waste management. Here's what waste management is doing. Is the right way to look at it.
That's right.
Who's going to argue with waste management or Republic Services for getting natural gas out of garbage? Right. I mean, is somebody going to raise their hand and say, I want less natural gas?
Making a new business, that's a very high return business. And so that's how we think about it, which is every
so it's sort
portfolio.
Of, in a way, I'm not sure it's the right word. It's politically neutral. I mean, who's going to argue with this, really?
Yeah, it's good business.
Yeah, at this point. I want to move on. You got that last one here, the supply chain ETF, SUP, S-U-P-P. Companies involved, it's just this word, supply chain transformation. And we can put this up here, what we own here. And so you're talking about companies like CSX, Martin Marietta, Waste Connections. There's Waste Management, which shows up in all of this stuff. In every, God bless them. I don't know how they keep showing up in these things. Tell us what goes on here.
Yeah, for sure. So we're just seeing a huge, durable mega trend around deglobalization and supply chain is coming back. So reshoring, huge trend. And if we just look at the numbers on that, there's been in the last couple of years $1 trillion worth of new projects announced, more mega projects we've ever had in North America, ever. And a third of them only where we've broken ground. So it is a huge, durable theme.
The word supply chain transformation, tell the viewers what that means in a practical sense. What happens here? What are these companies doing?
If I'm making a tractor, I'm going to, instead of making the bolt in Southeast Asia, I'm going to make the bolt in North America. I'm going to make it ideally near where I assemble the tractor. I'm going to build a new factory. The factory is going to have robots with very high semiconductor content. It's going to move equipment from somewhere in North America on a railroad to this new assembling plant where you're going to have very high IP content. The tractors have more semiconductors, and the whole system is sort of modernizing and pulling all of that commercial business into the U.S. It's great for American jobs.
It's fantastic. Yeah, onshoring. It's the onshoring theme. Martin Marietta makes sense to me. Will Scott Mobile, I don't know them.
Yeah, so think of it as like, again, at TCW, we're building these durable products where it's a mega trend and you can hold it for many, many years. So in the early part of the cycle, we're going to hold railroads. We're going to hold Martin Marietta, which helps you build factories. And Will Scott Mini builds, think of them as little containers. And if you go and try to build a new factory, you're going to use Will Scott, to put all your components and store everything on site. So that's a stock that we like quite a lot.
So it's really kind of an infrastructure play. It's investing in the actual build-out.
That's exactly right. It's an early infrastructure play. And then as we move through time, we'll probably hold the companies that have built all of these onshoring facilities because we're an active manager, so we can do that. Right now, the play is in these undervalued infrastructure plays as we start to onshore.
Where the buildings really happen.
And where the buildings really happen.
And as I said, this is essentially an onshoring play, too, because we now have this global problem with trying to figure out how the problems we're having with China. Apple's having them. Do they put it in India? How do we? And we have things like pharmaceuticals declared a national need, a security issue. Semiconductors a security issue. So moving them around more efficiently is an issue.
It's an issue, and the additional layer post-COVID, where we just couldn't move things, and you couldn't finish your tractor, to go back to that example, so you couldn't sell your tractor, so that's bad for the company. On top of that now, we want IP done, we want semiconductors done in the US, and we want to do things away from China and Russia, which just puts more fuel on the trends.
Right, and it'll take forever, but we're going to spend a lot of money along the road to forever, right? Trillions of dollars.
This makes absolute sense. I mean, here's a way to sort of depoliticize the whole issue to me. I mean, who's not in favor of it? And by the way, Waste Management, Waste Connections show up here. I'm sure Waste Management is doing something
durable plays
to make sure
Would
that...
you bet against Waste Management being a viable competitor in 20 years? I wouldn't.
Every time I throw something in the garbage, I think of Waste Management and Republic Securities. Waste Connections, by the way, that's
similar, yeah.
Similar, same thing. Yeah. Okay, it's all waste, folks. Thank you very much. This has been very interesting. I really enjoy talking about this stuff here. That does it for this week's ETF Edge. My thanks to Catherine and to Dave and to Jennifer, and we've asked Dave to stick around to provide us his thoughts on broader ETF trends for 2024. That's coming up in the ETF Edge podcast. And remember, you can see all of our shows. This is our 7th year, folks. It's on our website, etfedge.cnbc.com. Every one of them. I had brown hair a long time ago, believe it or not. Everybody have a healthy, happy, and safe. It is true. Safe trading week.
Get the ABCs of ETFs with the ETF Edge newsletter. Your weekly update on the hottest trends, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.